Going on, y'all? What's good, family? This is MFR, and I'm gonna just show y'all exactly what I did as I was looking at Netflix. You know, um, first thing we're gonna do is chart it out, and then after that, we're gonna look at the fundamentals of the company. So this is the technical analysis part, and then the next part is the fundamental analysis part. But this is a company analysis video. It's something I do on the MFR school every week. We pick I pick a company of interest at the moment, and I analyze it. I make sure the metrics are good, and I do some technical analysis to, you know, technical analysis is for the short term gain. It's for the short term, and then fundamental analysis is obviously for the long term. Like if you want to invest for years to come, you have to know that the company you're investing with is fundamentally sound. So when it comes to technical analysis, that's more for like within the year analysis. But here I'm typing right here that Netflix is in a downtrend, right? So Netflix right now is obviously in a downtrend. You could tell from the lower highs and the lower lows that it's making. It had a big price drop, right, to about right there. And this is a voiceover, so I did all of this, recorded it, and now I'm speaking over it. But like I just said, it's making lower lows and lower highs. That's how you can identify a downtrend when price is making lower lows and lower highs. That's what a downtrend is. Same way as when price is in an uptrend, that's higher lows and higher highs. So what I was typing there is for us to be interested, we need to basically see a break of structure. What was it that I wrote entirely? We need to see a higher low. There you go. I was outlining it for you guys, but basically, we would need to see a higher low because that would be a break of structure. If it makes another lower low, it's still in its downtrend. But as soon as it makes a higher low, then you understand. Okay, so structure is changing. Now the next move to look for is a higher high. So right here, I'm just mapping out where that low is, that point of interest, and then I'm marking up the other lows as well, so I know what levels I'm looking for. I color coordinate. You don't necessarily have to, but I want to speak on something while you guys watch this, because more often than not, you a lot of traders and investors, they get caught up in like they get caught up in what's not important, you know? Because primarily the main question people have when they're investing is what price should I buy this company at? Right? What price is a good price? You know, in my opinion, anything lower, whenever price is below its 200-day moving average, meaning that it's below the price has been 200 days ago, um, I always see that as a good opportunity to buy, especially if the company is financially sound. Like Netflix is a monster. You can't fuck with Netflix, right? Disney can't fuck with Netflix. Amazon Prime can't fuck with Netflix. Netflix got it right now. Full right now, Netflix got it. And this is me basically showing that it crossed and it made a higher high, right? So I'm gonna go back to what I was saying, but I want y'all to pay attention to this right here. This is the high that it broke, right? So it broke this lower high, making a higher high, signaling a structure change, right? So as soon as it makes a higher low, then you know that the structure is established. Now, the next thing to look for after that higher low would be another higher high. And then by that point, you already see the trajectory into which price is heading. So that's the new support right there. That's what it needs. Excuse me. That's what it needs to hold. It'll it'll never be exact. Price can definitely break below that, and then it'll just be one long wick, and then just continue on that uptrend. But essentially, this is me switching time frames, by the way, as well. When you see the candles change like that, that's me changing the time frame. So I think right now I think I'm on the 4 hour. So the time frames to take heed of, especially when doing technical analysis, is 1 hour and the 4 hour time frames. Right. I'm gonna still get back to don't think I forgot about what I was talking about, but I just want to say this real quick because this is super important. Right. So I'm just illustrating right here that there's buyers at this level. Right. There's buyers at this level pushing price up. Um, but you need to use the 1 hour and the 4 hour time frame because honest to God, those are the only ones that you can trust. The 15 minute and the 5 minute are merely for execution when it comes to day trading. But when it comes to swing trading, or I would say if you're someone that does leap options, then the 1 hour and the 4 hour are your bread and butter. If you're somebody that does swing trading, okay, yeah, you can use the 15 minute time frame, maybe the 5 minute time frame if you want to be precise in your execution. But for the most part, the 1 hour and the 4 hour, that's your bread and butter. So in this case, this would be like I would place an option contract on this, and then I would just hold it for a few weeks, if that, maybe a few months. But what I was saying here is breaking below this level would will mean sellers are still in control, right? So if sellers are still in control, obviously that wouldn't be a time to be putting any call options. But as soon as price breaks this level, then it tells you that there's more room for it to fall. So you wouldn't want to catch a falling knife, which is why I talked about earlier established trends, established structures. If price respects these new lows and these higher highs and it continues, then you already know, yeah, I could put a call option on, no problem. But excuse me. But if it doesn't and it breaks below that level, meaning sellers are still in control, then it should be for you to just wait and see. Waiting and see. And it's since Netflix is a very volatile company, it could definitely break below that and then rise right back to that level of support. And it'll just be a long wick, That's entirely a possibility because of how volatile Netflix is as a stock. It has a very high beta, meaning that the price can fluctuate to a very large degree. And this is essentially me showing what it looks like to make higher lows and higher highs. So price will fall before it rises. It has to correct. It has to collect money to be able to push past that previous high. So let's say it made that high down there, right? Where it started, where it made the new support. If it didn't have enough capital to push past that, and make a newer high, it would have to go down, collect stop losses, collect people's orders, collect some capital, and then push back up. So to go back to what I was saying earlier in terms of pricing, Netflix is stable and it has cash flow and it's projected to do better than it currently is. They just announced a 10-to-1 stock split. So you can already tell, okay, they're trying to invite more investors. They're trying to gather more capital. Netflix has been doing all the right things with all the money that it has. It has been expanding its business, doing the whole live games and the actual games that they have on the site. Like you play games on Netflix, which is crazy. But they're doing all the right things with the capital. So them doing the 10-to-1 stock split, converting $1,000 stock to $100 stock, that's them inviting more investors to the party so that they can use that capital because that's where their money goes. It goes to Netflix. When you buy shares, you're giving Netflix your money. And they take that money and they go about their business, literally. But this is the trend that I'm trying to illustrate in terms of it making higher lows and higher highs to then push past that 1200 level again. Because that's essentially what I'm targeting. I want it to go to that 1200 and then push past that and then go above that resistance up there in that red, that pink line you see, that's the resistance. And that green line that you see there is the support. So essentially, if it has enough uh, capital, it can push past that resistance and go on to make new highs. This is me illustrating because obviously you wouldn't trade on the indication being the top above the previous high. You would trade on the continuation after the correction. So if you could see how from the new support, obviously that would be an indication upwards, then a correction back to the new support, and then a continuation to the higher highs. So the continuation is where you would get in on your entry. You would never want to trade the indication and you never want to be a part of the correction. You want both of those to be established first and then get into the continuation after you know that the structure has been solidified. So I'm typing it right there, literally what I just said. But point is, you never want to be a part of the first two steps because that means that you will get liquidated. The All price is doing is looking for capital to be able to push past the price that it's currently at. So like I put there, after an indication is made and the correction makes an even higher low, because that's the point of the correction, to make a higher low. Upon the continuation, that's when we take our entry. That's when we'd get into position. But that's why price doesn't matter. You want your fundamentals to be sound and the structure of your technical analysis to be what you want it to be so that it goes in the direction you want it to go. At that point, price doesn't necessarily matter as long as it's above the low that the correction makes and a part of the continuation to go to those new highs. So if that just so happens to be 1134, $1,134 for the stock, if it just so happens to be that price where the entry falls at, then that's just the price to buy. You know what I'm saying? You don't need like a particular, like, oh, it's what was that thing investors say? What's that thing they say on CBC? Um it's below, oh damn, I'm forgetting. I'm spacing out right now. It's below fair value. That's what they fucking call it. It's below fair value. It's like that's nonsensical to me. How do you know? You said it's undervalued. Who decided that? You know what I'm saying? All of these things, all these terms for price and for these companies is merely just investor sentiment and what the investors think it to be. You don't need any of that. What you need is good price structure, good market structure, right? And good positioning. You don't need all the extra other stuff. If it's under or over fair value, who cares? What matters is if you make money or not. That's what matters. Are you making money? Is the stock making you money? Yes. Good. Then that's what matters. Everything else is bullshit. Everything else is nonsensical. Everything else does not matter. What matters is if it makes you money. You know, if it's below fair value, who cares? Right? If it's above fair value, who cares? You think I'm afraid to buy a stock at its 52-week high when it's one of the major contributors to the S&P 500? You must be out of your mind. Especially if I buy it at a 20% dip. You must be out of your mind from its all-time highs. If it's at a 52-week high and it falls 10% and you don't buy more, and it's one of the leading contributors to the S&P 500, then you're not an investor. You're a dickhead. You know, you're so passionate about getting it at the right price. There is no right price. If you don't get it now, then you're just gonna have to get it when it's $400 more expensive a year and a half later. You know, you're just gonna have to bear that and be like, oh, I could have got it at so and so, but I was waiting for it to fall more. Don't wait for it to fall more. Do not. It'll lead you nowhere. That bothers me too, because like why do investors do that? Why do they feel the need to just be like, oh, it's below fair value, so I mean it's above fair value, so I can't buy it here, even though it fell 20%, and it's one of the main contributors to the S&P 500, and it has amazing fundamentals, but because it's not at the price I want it to be at, then it's not a price I'm willing to pay for it for. Like that makes no sense. Look at this. It's Netflix, brother. I want to say there is a 95% chance you got Netflix on that, on whatever TV you got at home. I'm pretty sure. This is me typing because at the time, this is what the Skool community looks like, by the way. But like, I'm I'm 95% sure you got Netflix, buddy, and you don't want to buy it, but you're paying it every month. That's crazy to me. That's ridiculous. This is the news. So this is TradingView. Just so you guys know, this is what I'm using. TradingView. It's free. This is the 10-to-1 stock split news. Um, this is just some more news about Netflix getting involved with some whatever that was, some lawsuit or something. But this is me changing everything to annual, right? In terms of the financials, and I noticed here that they missed on their quarterly report. So I was just like, oh, really? Let me see why. But that 2022 and 2023, they missed on those years because that's when everybody was coming back from COVID. Nobody was watching Netflix as much anymore. Netflix had an enormous pop, and for them to continue and basically match that was impossible. You can't match a once in a 20-year event. You know what I'm saying? But this is me doing the math now. This is me checking the metrics. So the first one, the first one I'm doing right here is the total revenue divided by net income. So right there, I put it was 21%, I think. I think that's what I said. right? And next one was gross profit, right? 46%. Imagine that. Gross profit 46%. And companies with consistently higher margins of 40% or better tend to have some sort of durable competitive advantage. So the fact that it's 40%, 46%, that's amazing. That's great news. Right. So here I did the SGA, expenses divided by gross profit. So selling, general, and administration expenses. In the world of business, anything under 30% is considered fantastic. Right. Uh, they had 38%, which isn't, bad because the range you would want it to be is 30 to 80%. So it being 38% is actually pretty good. You know, like that's actually really good. And then I did interest expense divided by operating profit, right? In any given industry, the company with the lowest ratio of interest payments to operating income is usually the company most likely to have the competitive advantage. And this sheet that I keep going back to, right? This Google Doc, I made that. And it's free. It's on the MFR Skool. So you could just join it. The joining the Skool community is also free, but you could join it and then you could get that document for free. Super easy, right? And it just I highlight everything that's important, But what was it? 80 80 something percent? Hold up. I wasn't. It wasn't. It was 0.05%. So next is cash, right? So a high number of cash or cash equivalents tells us one of two things: that a company has competitive advantage that is generating tons of cash, which is good, right? So cash should be used to expand operations, buy entirely new businesses, invest in partially owned business via the stock market, buy back their shares, pay out a cash dividend to shareholders. These are the things that matter, right? They have plenty of that. So I'm looking at the cash and cash equivalents, right? I'm looking at the money, see what they got. Counting pockets right now. But Netflix got it. They got like 8 billion in cash, in cash equivalents. Like that's phenomenal. Like they're jumping right now. They got it, to be honest. Um what am I doing right now? Total current assets, right? Total current assets for Netflix was 1.3. Anything, the higher the ratio, the more liquid the company. A current ratio of over one is considered good, right? So property, plant, and equipment is next. They're consistent, right? Super consistent. It almost never changes. And their return on assets is 19.46%, which is really good. You know, it's actually really good. Um, right. So rate of return, obviously 19.46%. That's not bad. It's actually really good, but like anything, what's a good like metric to go off of? I'm not sure. Anything above, mm, anything above 10%, I would imagine is pretty good. And I say I would imagine only because Like Coca-Cola's rate of like return on assets is 12%. So I'm gonna put it like this: really high rate return on assets may indicate vulnerability in the durability of the company's competitive advantage, right? So if you want the company you're investing in, you want you want the barrier to entry to be super hard. Like you want the businesses to have a hard time competing with them. But I want to mention this. Long-term debt due. Total assets exceed long-term debt due via a 4-to-1 ratio, meaning that they could pay off all of their long-term debt with, you know, the majority of their assets can take care of that. That's not a problem at all for them. It, which is a good thing too. You want the company that you're putting your money in to be able to take care of any debt that they have on their balance sheet with the assets or cash that they have on hand. So Netflix can take care of that, which is amazing. And basically any given year the company has sufficient yearly net earnings to pay off half of its long-term debt. So without selling any assets, their earnings alone can pay off half of the long-term debt due, which is amazing. That's pretty good. Total liabilities divided by shareholder equity. Uh, that's 0.62 post adjustment. Why is that important? The post adjustment is the inclusion of the treasury stock, which is also very, 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 very important. So where is it? It's 33, and this is just me doing the math, really. Yeah, because it was way higher, like way, way higher, and I was just like, ain't no way Netflix is like, there's no way, right? And then I did the adjustment, obviously. The adjustment is adding back the underlying shareholders' equity with the treasury stock. So it's basically total liabilities divided by shareholders' equity plus treasury stock. That's the treasury stock is the adjustment, but it's anytime we see an adjusted debt to shareholder equity ratio below 0.8%, the lower the better, there is a good chance that the company in question has the coveted durable competitive advantage I'm looking for. So that essentially tells you that because of their great earnings power, they will often spend their built up equity slash retained earnings on buying back their stock, which decreases their equity slash retained earnings base. That in turn increases their debt to equity ratio, often to the point that their debt to equity ratio looks like that of a mediocre business, one without a durable competitive advantage. But because they have great earnings, they spend their built up equity on buying back their stock. Like they're literally buying back their company. They're investing more and more into their company, which is obviously it's a show of strength and faith in their business model. Might I add? You would only buy more of your stock if you're 100% in on it. You know what I'm saying? So like I'm gonna give you some examples of mediocre businesses, and you'll see that their Debt to shareholder equity is outrageous. Like Goodyear Tire, 4.35%. It's crazy. Ford, 38, which is ridiculous. 38.0. General Motors, like I didn't even put it. I just put LOL because I was just is ridiculous. Um, but preferred stock, zero. You don't have any preferred stock. Retained earnings, their annual compound, their their retained earnings is growing 48% year over year. It's annually growing at 48% year over year. Their retained earnings, right? Their capital expenditures is 0.06% of net earnings. So what they spend to make the money is 0.06% of their net earnings. And their return on equity is 42.86%, which is really, 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 really good. The return on equity is 42.8%. Like, think about that. You bought some and your equity made you 42%, 43% almost. But Netflix's free cash flow grew at an approximate 22.95% annually from Q4 2017 to Q3 2025, right? So think about that. Imagine your cash. Imagine you had money sitting on the side and it rose 22%, 23% damn near every year since 2017. And that's just your cash pot. Like that's the money coming in. You understand me? Like that's your revenue. That's your money coming in. Your the money that's coming in after the expenses, after everything is growing. Your business is making your money grow more. Is making your You guys are making me like you're gonna give me an aneurysm. The money you earn, there's just 22%, 23% more of that every year. The money you earn, imagine just getting 23% more every single year of what you get paid, of what you keep after you get paid and after you take care of expenses. Imagine that number is just growing every year, 23%. That's phenomenal. That's Netflix. You know what I'm saying? So if you liked everything you seen and you want to see more, then like, comment, subscribe, and share this to anybody who wants to get started in investing. This is MFR. Thank you for your support. I love y'all family. So I'm gonna holla at y'all. Have a blessed time.